In the world of high-stakes finance, there's one number that can literally make or break a deal: the internal rate of return, or IRR. It's powerful, it's absolutely essential, and you know what? It can also be pretty confusing. So today, we're going to demystify it. We're going to break down how investors, especially in private equity, use IRR to figure out where to put their money. Let's dive in. Okay, so let's put you in the investor's seat for a second. You're looking at two different opportunities, and you can only pick one. Now, it might seem like a simple choice, but as you're about to see, picking the real winner requires a very specific tool. So here's the puzzle. Fund A triples your money in 5 years. Not bad. Fund B, well, it also triples your money, but it takes 10 years to do it. They both get you to the same place in the end. So which one is better? Your gut is probably screaming the faster one, right? But why? And maybe more importantly, how much better is it? This is exactly where just looking at a simple return multiple, it just doesn't tell the whole story. The missing piece in this puzzle, the thing that changes the entire equation, is time. It's the one factor that fundamentally changes the value of money itself, and with it, the true value of an investment. You've probably heard this saying before, and it's one of the most fundamental principles in all of finance. A dollar today is worth more than a dollar tomorrow. So, why is that? Well, it's simple. A dollar that's in your hand right now can be invested, it can be put to work, and it can start earning more money for you immediately. This whole concept has a name, of course: the time value of money. It's the idea that cash you have now is just flat out more valuable than the exact same amount in the future, all because of its potential to grow. Understanding this is the key to finally solving our Fund A versus Fund B problem. And that brings us to the hero of our story today. We're about to unlock the IRR. This is the financial tool that was built specifically to solve this puzzle of time and money, giving us that true apples-to-apples comparison we've been looking for. So what is IRR exactly? Well, it's the annualized rate of return on an investment. But here's the critical part. It accounts for the timing of every single cash flow. It's not just about the final profit you made. It's about when the money went in and when it came out. This is the precise solution we've been looking for. You can think of it like this. The IRR calculation is basically a balancing act. It's working backward to find that one single magic interest rate that makes the time-adjusted value of all your investments, the money that went out, perfectly equal to the time-adjusted value of all your returns, the money that came in. It's the one growth rate that explains the entire journey of your money, from start to finish. Okay, theory is great, but seeing this thing in action is what really makes it all click. So let's walk through a concrete example to see exactly how these cash flows come together to spit out an IRR number. To calculate an IRR, you really only need two things. First, you need to track all your cash outflows. That's the money you invest. We treat these as negative numbers. Second, you track all your cash inflows, the money you get back, like your profits or any distributions, and these are your positive numbers. That's it. It's all about the money in and the money out. So let's map this out. Imagine in year 0, you invest $100,000. 2 years later, you get a small distribution back, say $20,000. Then in year 4, another $50,000 comes in. And finally, in year 7, the investment is sold and you get a final payout of $150,000. Okay, we have our timeline and we have our cash flows. Now we can find the IRR. And there it is, 15.6%. Now, that single number represents the annualized rate of return for that specific series of cash flows. It means that, on average, this investment performed as if your money was growing at a steady rate of 15.6% every single year, accounting for all those deposits and withdrawals along the way. Pretty powerful, right? That 15.6% isn't just a number on a spreadsheet. It's an incredibly powerful tool. So let's talk about why. Why is this specific calculation considered the ultimate performance metric for so many professionals in the world of finance? Well, IRR really serves two primary functions. First, it's all about performance measurement. It allows a fund manager to compare completely different deals, maybe one that lasted 2 years and another that lasted 10, on a standardized, totally apples-to-apples basis. Second, it's a huge tool for fundraising. A fund manager with a history of delivering high IRRs can use that track record as hard proof of their skill when they go out to ask new investors for capital. And it is crucial for both sides of the table. For the investors, the limited partners or LPs, IIR is their go-to tool for comparison shopping between different funds. For the fund managers, the general partners or GPs, it's a planning tool. They use it to model potential returns and build a really compelling case for why a deal is worth doing in the first place.
So ultimately, IRR gives you a much more complete, much more accurate picture of an investment's real success. Simple profit tells you how much money you made, but IRR adds that absolutely crucial context of when you made it, and it correctly values a fast return over a slow one every single time.
And that leaves us with one final thought-provoking question. We've established that IRR is the perfect metric for measuring the speed of your return, your annualized growth rate. But what about the size of your return? What metric simply tells you how much money you made in total without worrying about time? Well, that's a story for another explainer.